Lung adenocarcinoma confirmed.
Imagine knowing the top 5 tech stocks set you up for an amazing 2025. For those of you short on time, TikTok's burned most of your brain cells. Here's what matters. These 5 companies I'm about to show you have collectively invested hundreds of billions of dollars in AI infrastructure just in the last 18 months. The tickers, I know some of you are already impatient. It's ARM, it's Meta, ISRG, HIMSS, and NVIDIA. And in the next few minutes, I'm going to show you the key numbers that matter, the entry points, and the warnings every investor needs to know to be a winner for these particular stocks. Now, speaking of finding winners, if you want to learn how to spot stock breakouts without having to follow a guy on YouTube and find those breakouts before they happen, and then learn to sell the stock before the stock inevitably collapses, because that's pretty much what happens to every stock, I have something very exciting to share. I've actually recorded those very rules that I've learned from my mentors who've been investing and trading for decades before I was even alive. And I've put all of that information to just a 15-minute masterclass, again, catering to the TikTok brain damaged. And you will literally learn the entry point, the exit point, how to automate the whole lot, and live a beautiful. You want to get access to that? It's free of charge at felixprehn.org/get-free, and it's part of our mission to make 1 million people financially free, so we have more people to hang out with. Head over to felixprehn.org/get-free and get yourself the access right now. And honestly, that's far more important than this video. So if I see a massive drop-off in viewers at this particular moment, I'm going to be insanely happy because you made the right decision. You made the smart decision. You improved your skills through education, rather than looking for what's the latest stock. So anyway, let's start then with our first company. We're going to jump straight into it. ARM Holdings. It's a business that's quite literally powering the future AI. And maybe you're thinking, ARM, isn't that the company that makes chips for phones? Well, yes, they do design the brains for most smartphones, but that's really just scratching the surface here. Think of ARM as the architects of the digital world. They don't actually make the chips themselves, which is a good thing, but they design the blueprints, the intellectual property, or IP, as we say in fancier sort of legal circles. And that allows companies like Apple, Samsung, Qualcomm to use those blueprints to build their processors. Here's the very, very clever bit. ARM gets paid twice. First, they license the design to these companies. That's an upfront cash in the bank. Then every time a chip gets shipped using their design, ARM gets a little tiny royalty, a tiny cut. But when you're talking about billions of chips, these pennies add up to very large piles of dollars. Billions of dollars in this case. So why is ARM then a must-watch for 2025? Well, here's the question. What powers AI? Compute power. And who designs some of the most energy efficient and powerful compute architectures out there? Yeah, you're right. Spot on. ARM. How did you know? And their chips are becoming essential for everything AI, from your phone to fancy photo editing, massive data center crunching numbers, and the latest AI models. They're pushing new architecture called version 9, which is faster and more secure. It's sort of like upgrading from Mini Cooper. Do you know what that is? An Aston Martin. That's sort of what they're doing, and it's being adopted like absolute hotcake. And data centers, real growth is there at the moment. The big boys, the Amazons, the Microsofts, the Googles, even NVIDIA, Tesla, and so on, they're all designing their own chips using ARM's technology for their data centers. Why? Because ARM's designs are power efficient and therefore cost effective and increasingly powerful. Kind of a no-brainer, really. And then there's the extra layer on top, the peanut butter, if you will. They have strategic partnerships with OpenAI, Microsoft, NVIDIA, basically all the cool kids in AI, and they position themselves right at the very, very heart of the AI revolution. So, should we look at some numbers? I think we should. Cash flow and growth health are both looking very, very healthy. We give them a school card B for both. Price momentum is an A. What does that mean? It actually means the stock's gone up a lot. Not necessarily the greatest thing if you're not in it yet. And then we have profit health, which is a B, which is very, very good. Now, relative value is an F for fail. But sometimes you have to pay for quality, especially when you're talking about a company that's at the forefront of the greatest tech shift we've ever seen. And you'll find that most great companies at present have an F. Does that mean we shouldn't invest? No, it doesn't mean that. It just means expectations are high. So yes, there is some risk if they miss expectations, but it also might just mean that everyone agrees this is a really, 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 really good company. So Arm's a beast. There is a little thing called a moat, and you hear Warren Buffett talking about this a lot, for example. It's basically saying, how hard is it to replace this company's products with another company's product? So say if I had, I don't, but say if I had 2 phones in my hand here, I'm using one to film this, if one was made by Samsung and another one was made by, I don't know, somebody else, how easy would I shift? That's sort of what the moat is. And how much money am I therefore willing to pay for this product in addition to what the other guy is charging me? Let me give you a real example. Okay, lemonade, juice, right? Now, if they both charged $1, you'd pick the one that you prefer. If these guys came in and say, but this lemonade is $10, this is still $1, you're probably going to buy that one, right? There isn't a very strong moat here. It's just kind of a little bit of preference. But with tech, when you have tech that is so extraordinary that you can charge whatever you want, you get to these super, super, super high margins. And these guys have a 96% gross profit margin, which is the measure of a moat. 96 out of 100. That's like, you just don't see that. MasterCard has a similar crazy margin. That's pretty much the only business I can think of with that sort of margin. So they literally are a monopoly for what they do. Otherwise, you would not get people to pay that much for your service. They can basically charge whatever they want, and therefore it's just an insanely good business. Very, very, very simple. So shall we look at the chart so we see how we could trade a thing like ARM? Let's open it up here. ARM Holdings, and I'm using tradevision.io, which is the platform that we built and that we use, and it gives us insanely good information in both of news. It gives us options, it gives us insights to dark pools, it gives us brand new out now the key dates that are happening in terms of events every day and everything else, and it gives us some really, really, really cool and amazing indicators. But let me just turn them all off first to make it really, really simple. The first line I would put on here always be the 50-day moving average line. That yellow line there. You generally speaking want to be above that if you think something's, if it's going up. But what you will also note is that we're actually at the same price point we're at in February last year. The whole chip sector hasn't really done that well in the last year, and that might surprise you because we're all talking about AI, but they just haven't really done that much. So what does that mean? Well, it's potentially not as expensive as it looks. That's really what that means. Now, is this a brilliant entry point? Well, it's not a classic breakout. If you watched my masterclass, you know what I'm talking about. We had a few sort of blips there, but we haven't really had the real breakouts yet. What was the last breakout? Have we had one here? Well, we certainly had one down here in February 2024, but that's been a long time coming. So here's a company, 96% gross profit margin, growing insanely well, that we need to build AI chips, and trading at the same valuation it was trading at exactly bonkers. I'd say absolutely bonkers. And then we have support sitting here at the moment at 155. That's actually where real market positions are. So another line that we make up. It's really where think of it as a sort of the hedge funds have to buy at these levels. Then they have to sell at 170. We're right now trading at 158. That's probably just a little bit market sentiment in the last couple of days. So you want to break through that 170 here to really get it going. But it looks pretty positive from where I'm sitting. Earnings must be coming up fairly shortly. The last ones were in November, so December, January, February. So we should expect them in early Feb. I haven't got the date in here for some reason. Maybe they haven't announced it yet. But the longer the consolidation, the larger the potential breakout. That's sort of the way I look at it. Financial advice, if you come to your own conclusion, I'm not telling you to buy it. I'm just saying, look into it, do your own research. I think there's something pretty interesting here in ARM. Now, next, we have a stock that most people hate, let's face it. People call it Facebook. Now, it's called Meta, according to Zuckerberg, the master of the universe. People say nobody uses it. And it's just because a lot of people don't like it. I totally get that. But something like 3.1 billion people a day use Meta services. I mean, I would not make it through an hour without using WhatsApp, for example. So people write the stock off, but if that's kind of where your mind's at, let me just show you a chart because that might give us a little bit of clarity here. Meta isn't really a social media company. They're not really Instagram or any of those things. Meta is an advertising company, so it's a publisher. All it is, it's basically the newspapers of 100 years ago. And look at that chart, right? This is what it's been doing. It's going insanely up. It's a money printer. And because people advertise. The whole technology shift we've just been seeing with AI, I'm in the midst of, makes it possible for advertisers to make a lot more money. And therefore, platforms like Meta make a lot more money. There really are only two places you can advertise. One is Meta's world, and the second is Google's world. And then everyone else is pretty much irrelevant. So these guys are just making a lot more money. A lot more money. And therefore worth exploring. Even if you loathe the company, maybe you think Zuck is a creep or something, although he seems to be looking a little bit more human-like of late. That's not really what it's about. It's about, can we make our money make more money for it? So let's jump straight into the scorecards here for Zuck's little company. Cash flow is a B. Growth health is a B. Price momentum is an A. Relative value is a D, which is actually pretty cheap. It means it's kind of a sort of a bargain basement stock almost. So you're paying for quality and future potential, but you're not paying as much as you are for ARM. And an A for profit health just means crikey. And they're investing. They're going to spend something like $60 billion on AI infrastructure. So where's it all going? Well, a lot of that is going into NVIDIA, and we're going to get to that in a second, and to some extent into ARM. But they've realized that the core advertising business, the massive cash cow, and the AI investments they're making are insanely promising to make that cash cow bigger and bigger and bigger and bigger. So to me, it's actually a very, very low risk play on AI because they've already proven that it works. They don't need to build the chips. They don't need to have any massive tech hurdles. They just need to process the billions of bits of data they get every second and do that better. They know you better. They don't just know you through scrolling through Facebook or Instagram. Every website in the world has something called a Facebook pixel. It allows Facebook to track what you're doing, everything about you, and you might not like it, but you might want to make money out of it. At least that's the way I see it. So how do we get in on a stock like Meta? Well, I think, I'm not quite sure why that line there is sort of in the middle of nowhere. I think that was meant to be over here. Draw a new one. That blue line there, let me make that purple so it's a little bit brighter, sort of connects here these highs. And I think that was kind of the sort of breakout just before earnings. Earnings came in, they were very good. We were going stronger up to 720. I think 750 is next. A little bit of a concern that as we're going higher up here, volume is fizzling out a little, but it is pretty strong. Certainly a lot higher than it has been on average in the last couple of months. I think the momentum is still there. I think it's just, I just think it's one of these long-term. Can't really go that wrong with Meta, and probably a stock where you could actually just buy it just fine. Now let's talk about something completely different. This is Intuitive Surgical, ticker symbol ISRG, and I guess not many people might be familiar with it. It isn't your typical tech stock. They're not churning out software or chips. They're in the business of robots, surgical robots to be precise. Have you ever heard of minimally invasive surgery where they make a teeny tiny hole? Well, the Da Vinci robot was probably involved. These guys build these very, very complex robots, and then they sell them to hospitals. Here's the clip of it. They don't just make money selling the robots themselves. That's just the start. The real recurring revenue comes from the instruments, accessories, and the services that go along with these robots. And that's the classic, brilliant business model that you'd have, is you sell somebody a machine, and then that machine only works with your little accessories and bits and refills. Remember the printer? Do you still have a printer at home? Right? The printers are like $50. The ink, $1 billion, right? And that's how they make money. Same with these guys here. So hospitals buy this Da Vinci system, and they need to keep buying the specialized little instruments, like the razors and the razor blade. Again, you buy a razor, it's like, oh my God, it's so cheap, I get 5 extra blades. And then the next time you go into the store, they say, sir, you're going to have to take out a mortgage to buy the plates, right? Same system. Very, very clever. So what's driving their growth? Procedure growth. More and more people are having robot-assisted surgeries. Because, well, it's better. It's anything from prostate removal, which sounds absolutely horrible, hernia repairs, all that kind of stuff where people used to make a big hole, now they can make a little hole. It means the patient recovers faster, you damage less stuff. And so Secondly, they have more and more of these Da Vinci robots installed. More hospitals around the world are buying the Da Vinci system. So not just in the US, they're now growing in places like India, the UK, Italy, Japan, and so on. That's a massive opportunity for them. Remember what I was talking about the last stock, the first stock, the ARM stock, how hard it is for customers to go switching cost, like the moat. Once a hospital buys a Da Vinci system and trains its surgeons to use that robot, they're not going to switch to a competitor. It's a sticky business in the best possible sort of a way. Makes me think of blood now. Weird. Anyway, I digress. Let's look at the scorecard here. Cash flow health is a B, growth health is a B, price momentum is an A, profit health is a B, relative value is an F. Spot the pattern. F for value again. Felix, give us some cheap stocks. Well, I want to give you great stocks, not cheap stocks, to start researching. And in a high quality business with a dominant position, well, guess what? People will have caught on that this is a pretty good thing to be in, and therefore have high expectations. Therefore, the stock isn't particularly cheap. So let's have a look at the ticker here. The Trade Vision again here. Make sure you get yourself a trial to sign up to that. So where was the last breakout that we called? We called one down here at 367, at 463, and just now at 587. We're now trading at 592. And one thing, if you've watched the masterclass, that you'll start to appreciate is that breakouts very, very rarely go straight up. Would be nice, right? They typically do exactly this. They do something like that. That's typically how stocks move. Stocks don't go up in straight. Said to me the other day, Felix, that Commander stock you talk about absolutely crashed. And I'm like, down 3% in the last day. It's up 15% in the week. It's like planting an acorn and saying, where is my tree on day one, right? It doesn't quite work like that. It just means you're new to this. So let's switch again here. Hims and hers. And I used to think that was sort of a weird, matching jumper shop. That's kind of what it sounds like. But apparently it isn't. They're basically an online doctor and a pharmacy all rolled into one. They offer treatments for all sorts of things. And I think the idea, if I'm not mistaken, probably came out of something like some of the early Chinese health apps that were out there, which were really, really brilliant ideas. And they made a lot of money for a while, and then politics got in the way. But they treat stuff like hair loss, mental health, skincare, all the kind of stuff that people might be a bit embarrassed to talk about. Nobody wants to walk into a pharmacy and say, I've got an itch in a very unpleasant place, right? You don't want to have that conversation. People now think they'll have an itch, right? People go to someone like Hims and Hers. So what's driving them? Well, we got telehealth adoption. People are getting more and more comfortable with seeing doctors online. It's convenient, it's often cheaper, it's more accessible, especially if you're, say, in a rural area, or maybe you're not that mobile, right? Maybe you haven't used your legs properly, and your body weight on top is 6 times the weight of your legs, and therefore it's a little hard to, vertical. Secondly, they're expanding their products. They started with some key areas, and they started adding treatments, and more customers, more and more treatments followed. And they're building a brand. It's a recognizable brand now in the healthcare space, and they're using data to tailor your treatment plans to individual patients. It could be more effective. It could keep customers coming back, and so on. So what's the scorecard here? Well, let's hit you with it over the head. Well, the cash flow is great. It's a B. Growth health is an A, which is amazing. Price momentum an A. Okay, the stock isn't cheap. Profit health is an A, and relative value is a D. D again. Sounds D for value. So another growth stock here. Not massively cheap, but look at those A's for growth. And remember that gross profit margin I was talking about for ARM was 96%, which is out of this world. These guys have an 80% gross profit margin, which is also fantastic. Amazing. Revenue is up 57% year over year. That's like hyper growth territory. Next earnings are out later this month, so definitely watch out for those. But I think the outlook here is pretty positive. The growing market, they're well positioned. Challenges? Yeah, competition. There are other telehealth providers out there. Amazon is muscling in on the game, which is the one I would really watch out for. Amazon is sort of like the sneaky one. You cuddles up to you, and then you realize it's an anaconda that's going to swallow you whole. But we've got Hims and Hers here. High growth, high potential, high valuation. True. Well, let's look at the charts and see whether that's something we might want to consider, and of course you always have to come to your own conclusions. I would learn the rules really, which I give you if you watch the masterclass, so I don't have to repeat myself in every single video, and you can also play it back, and I think it's a lot more accessible that way. Play it as often as you like at any point. Well, first of all, let me show you the breakouts that we called inside Trade Vision here. So that was down there at 9, this was at about 16, last one was about 32, and we're now trading at 43. So pretty good, right? And you see the pattern that I was alluding to, and then I mentioned this also in the masterclass. We go up, a little bit down, up, another breakout, up, a little bit down, right? And go up again. Then here we went up, we went down again, and then boom, up again. So stocks don't work in a straight. Something to bear in mind. You get in on stuff. So what do I like about the chart? Well, you see how strongly it's going up here the last few days, and you see how strong the volume is. Volume is usually down here. It's doing that rally on about double the volume. That means a lot of institutional buying is happening here. So we like it. All right, last but certainly not least, we have NVIDIA, this little tiny little chip company that you've probably never heard of. Well, if you're like me, you maybe owned an NVIDIA graphics card in the sort of good old days of the, I don't know, 2000s or 90s even. And they used to make gaming chips. And now they make data center GPUs, autonomous vehicle chips, and all that kind of stuff. They're the kingpin of the whole AI thing. We wouldn't have AI without NVIDIA because we wouldn't be able to run the compute power. Before we get into the nitty-gritty numbers, I want to show you the chart. Because everyone's assuming that this thing has gone to the moon and therefore the opportunity is missed. And I think quite the opposite is to zoom out and draw a horizontal line where we're trading right now. We're at the same price levels out where we were in June 2024. We have literally done nothing at all in the last 8 months. And my wisdom is always the longer something goes sideways, the bigger the potential breakout, just because, well, the stock's been growing, revenue's been growing, profit's been improving, making better and better products, more and more people are using it, and there's still a massive backlog. If you paid attention to Google and Microsoft earnings last week or so, they both said, look, we'd like to grow faster, but we can't. Why not? We haven't got enough chips. So that means NVIDIA has pricing power. People are just begging them for it. And it means the growth in their demand is still very, very much there. Insatiable. I'm describing that demand. So what do you do when there is insatiable demand? Well, unmet demand, actually. Just people want to buy chips and they can't get any. And it's just bizarre, right? It's like you want to buy, I don't know, some sort of rare sneaker and this just isn't available. So the sneaker price goes from $300 to $1,000 to $30,000 to, it's like comes like a classic car collection. And the only people who can realistically fill that gap is NVIDIA. The real demand is only just kicking off because AI is moving to the edge. Now, what does that mean to the edge? It means you're sitting on the edge of your seat? No. Autonomous vehicles, robots, industrial automation. So at the moment, all these chips are going to a centralized data center and then we just access it through Wi-Fi. But these chips are actually going to move into, well, they're moving into phones. That's a thing already. But they're moving into the robots that are out there. And the car is a robot in many ways, the robots in factories and so on. So we're going to need so many more chips because there won't be these centralized chips. And autonomous driving, for example, they've got this drive platform for self-driving cars. They've got the Jetson platform for edge computing. They position themselves to not just dominate the current AI wave, the data center wave, but the next waves coming. So they're building the future infrastructure, not just the present one, and therefore I think growth is going to be insane. Let's have a look at where they are right now. Cash flow is a B, growth health is an A, price momentum is a B, this is quite good, profit health is an A, relative value is a D. It's the D for value. So, not cheap, but if you look at all those A's for growth, well, I quite like it. And financials, well, don't get me started on that. Margins are insane. And they might have some pressure on those margins if AMD and Intel ever get their heads out of the sand. Eventually, those margins will get somewhat compressed, but I think we have here a 2025 and a 2026 that's going to be absolutely extraordinary. Another year of explosive growth. If you look at the chart, what do you see? Well, you see we're slightly below this yellow 50-day moving average line there. It's kind of recovering a bit. Not brilliant when you're below that. The second line would be the 150-day moving average line. Use a different color pen here to make it a little bit clearer, which is this one. Now, we're above that again, which is a good thing. If we break through the 50-day here again, which is about 138 or so, then I think we head back to the 150, which is kind of where we've been in terms of highs. And is that going to happen? Yes. When is it going to happen? I can't tell you that. It's secret. No, nobody knows that. But to me, the momentum here still seems very much intact. I think the demand story is very much intact. We still don't see the competition, the rearview mirror, anywhere. And I think they're going to deliver another set of blowout earnings. So they delivered blowout earnings in August and the stock tanked, and then we recovered. In November, they delivered insane earnings and the stock didn't do anything as a result. So, earnings data in itself isn't necessarily going to do that. The last ones that really blew stuff out of the water were the ones in May here, and you can see the little breakout indicator on here. So watch out for the breakout indicator. Trade vision, kind of what I would do. And then obviously have some really, really good risk management. So there you have it. 5 companies that I think are going to be the hottest things, or certainly part of the hottest things of 2025. We've got ARM for chip design, Meta's AI-powered adverts, and creepy listening to our conversations. Intuitive Surgicals, they're robots, just a whole thing with a whole ecosystem. Hims and Hers, digital healthcare, and then NVIDIA just powering the lot. There you are. If you got some value out of this, do what? Watch the masterclass. It will give you 10 times the value you got out of this video. Share this video with a friend and let me know in the comments that you've watched the masterclass. Just write MC or masterclass. I'll know it, I'll see it, and I wish you all the best. That's not science fiction, that's